Is Markets with May. And today we're going to talk about Carmax, which I generally keep my eye on Carmax because not because I have a position in Carmax, but because I have a position in everything surrounding Carmax. So we're going to talk about Carmax, but I'm going to layer in how I'm thinking about it for the financials which report on Friday, CPI, which is reported tomorrow, and also Carvana, Upstart, and Ali Financial. Past performance is not indicative of future returns. I currently, what do I have a position in right now? I have a bunch of positions in financials for sure. I think I went ahead and took some bearish positions in Carvana and Upstart. Sorry, guys, is what it is. But I structured them more like calendar spreads because, quite frankly, I'm just really worried about what's up. I think well, we'll get into it, and then you guys can make a call. I mean, in some ways, my bearish positions have more to do with General B being a little concerned about the marketplace and a little concerned that I'm a little bit long. But yeah, so it's not like none of my position sizing is particularly large right now. All right, let's get into what happened at Carmax. All right, 1 second, 1 second while I switch it up here. Okay, let me share my screen. Well, before I share my screen, I just want to kind of go over this. I am going to actually go through three things. So I'm going to review the quarter. I'm going to give implications on the auto markets and what therefore Carmax is saying they're seeing. Then I'm going to talk about the implications to the debt markets in general. And then we're just going to really remind each other of what's up on CPI, and then we'll take questions. Okay, so that's a format. Let's get into it. Cool. My little slide of notes. All right. If you look at the quarter, it wasn't a great quarter. Look, this bad boy was up 10%. Revenue was down 25%. And EPS, net income was down 57%. And for whatever reason, this was amazing sauce relative to street. And so I will talk to that in just a second because I kind of feel them on that. But there are some strong caveats. But going through the income statement, you can see that used was down 21%. Wholesale, oh my gosh, ouch. Wholesale was down 42%. You know, other people that have the wholesale business, that's going to be GM and Ford. Tesla doesn't have nearly the same exposure to wholesale. I'm not going to say they don't have it. And then Carvana loves a good wholesale business. So that 42% down is a little bit painfulness, but in fairness, the wholesale business in general is a lower margin business. Now, what I think kind of goes a little special sauce in the way that they did their financials is that you'll see that they do like they're missing a line, let's call it operating income. And then they stuck depreciation amortization, just skipped all the way down to EBIT, which is earnings before income taxes. And why do I find that a little special sauce? First of all, I don't, for whatever reason, remember them doing that in the past. Maybe they did and I'm wrong. I'd have to really go back. But it really underlies the fact that these guys don't have operating leverage, okay? They were able to get COGS down, cost of goods sold, down 27%. What's that mean for an auto retailer? It essentially means that they bought the cars and sold them at a decent margin. So they were able to get some pricing over the cheapness that they bought the cars at. So that's good. But the operating piece, if you look very closely, comes from the one piece that I'm always worried about and care about, and it comes from auto finance income. Okay. That was down a lot, as far as what happened there, not ideal. But as a result of that, when you flex through the numbers, you have operating costs 571 versus 544. Okay. So auto financing income, I have like a mixed feeling about. And really almost all of it is about financing, because when you go to buy a car, these are used. This isn't a bunch of rich folk buying their baller car. This is used cars, people trying to get to work. Okay. That's what this is. And so we really want to watch this segment of the population a lot, because this is really going to bleed into the banking system. In particular, it'll bleed into a couple of guys that I've already been worried about, namely the auto and lending originators. So let's actually break that down. Okay. Let's talk, right? Okay. EPS. Oh, one other thing before we talk too much further about it. EPS was down 56%, net income down 57%. They bought back 1.8% of shares, which I think is really ballsy, quite frankly, and really kind of concerns me only in so much that it really indicates that given that they are no longer doing that at this point, the deterioration must have been significant in the last quarter, so to speak, right? They really were very clear that they will not be buying it back because they kind of want to just hold cash into this next year. That's not a good sign as far as it goes. Yeah, James is, you know what? I love you guys. Some of you guys are in the autos business. So definitely, like, if I've got extra stuff, I would love to hear what you have to say because I know a couple of my followers know that business cold. All right, balance sheet. This is where you really got to look this time. Now, usually I present the cash flow statement, but it's not quite as relevant because all of it is very clear on the balance sheet. This was their fiscal year end. And we see cash up 134 million. The number actually matters. It's about 20% up on cash once you take the restricted cash and then the cash and cash equivalents. That restricted cash, by the way, is because you've got really two businesses here. You've got the autos business, I'm selling cars, and then you've got the financing business. And so that restricted cash represents kind of like reserve for loan losses, stuff like that. Okay. But it also represents other cash. The reserve, I will go through the things they said, but did not clearly print in the press release on the call. Loan loss reserves were up, so let's not get confused by this balance sheet. Okay, inventory was down 27%. They raised about 1.4 million in cash from that to pay back all the other stuff. Auto loans receivables were up $1 billion. Okay, that's where the loans are going if we're confused. So this does not tell me, even with all of the stuff that they said about getting 5 new banks, yada yada, all this stuff, until they're selling cars. I just want to at all times understand if they're holding any of the loans at Carmax financing. That's the only thing I care about. And it's the only thing that they don't clearly demonstrate through their numbers. They talk through some of it, but it's not enough for me to be like, yo, this is all good. So that is the one thing that I'll be monitoring as we carry forward. That said, I still think they're probably okay. So I'm not, and we'll talk about it a little bit more. Non-recourse was up. Hold on, that is probably, yeah. So non-recourse lending was up 946, long-term debt down 1.3. But to me, that still leaves a bit of an increase on the auto loans that are held internally. Now, they had a lot to say about their lending book. The first thing they said is that the loss reserves are more or less up just a little bit, 3.02. That's this number. So they increased loan loss reserves 3.02%, so 507 million versus 491. It's not a huge increase, 2.94% from 3%. And then they told you that they have about 1.9 billion in loans, some of which are kind of newer sales that just happened this quarter. So you can't take that full number as the entirety of the book. You can't get too upset about that, but it's an increase in the net loans. And we didn't see an increase in sales, right? So there's that. And the weighted average percent that they got in interest was 10.9%. Things that they don't give you. They don't give you like, what is the average FICO score of that? So I pulled this off of the internet so that we could get a sense for what the FICO score might be. So it's going to be somewhere between prime and subprime, because this is what the going interest rate is right here, guys. Let me draw you a second box so you can see it very clearly. This is how you would try to get an implied rate. I mean, honestly, I think if you have a lending facility within you and you're not giving this, I am not a happy girl with you. Let me just say it very clearly, right? Because if a huge chunk of your business is lending and you don't give me this, then I have a reason to not be stoked. That's part of the reason why I'm kind of not touching Carmax, because honestly, when it comes down to it, I'm still kind of like, maybe it could work out. But here's what we're seeing. These are the average APRs on used cars right now. And so if they're getting a weighted average of 10.9%, then they're somewhere probably on the lower end of this FICO score. They're probably closer to 660 on average, weighted average. Okay. And so we'll be watching that, because obviously that's the billion-dollar question. Does a crisis in confidence become a crisis in credit quality? So thus far, it's really been something else, a bank run, more or less liquidity crisis. Okay, so tier three, they did mention tier three lending is tightening. What the world does that mean? I think that's their verbiage, not everyone's verbiage, by the way. That's their verbiage for non-prime, the third bucket here, which is non-prime lending. So basically, if you are not 660 credit score or above, it is significantly harder right now to get a loan. And that's kind of what they were experiencing already. And so what do I then think of Carmax up 10% today? Well, I can't get super upset with them. Okay. If you use the full year estimate at 3, they're trading about 33 times current PE. Is that cheap? Is that expensive? I refuse to kind of go here, and this is why. Because if you actually think things are going to turn, then 23 times, 24 times for something that legit will be the market leader, because one way or the other, this is, for better or for worse, going to take some of the smaller mom and pop shops out of the business. You know, some people are just going to decide they want to retire and they're done with this business. Some people are not going to be able to afford it because they're not going to be able to get inventory or anything like that. So it's possible that they push more players out of the marketplace. Recall that the used car business is actually not a consolidated industry. Depending on where you look, you'll see that the top, X number of players do not have greater than 50% of the market. So yeah. So at 23 times, if you think we're turning through that's the bell for my rice cooker, guys. We got dinner after this. But sorry, back to our story. If you think this is the bottom for auto lending, then or if you think this is the bottom and that after this it's all going to be unicorns and rainbows, then at 23 times, it's actually not that big of a deal for something like Carmax, which probably will have taken market share. They were very clear on the call that despite the fact that they're clearly running off inventory, they're going after their competitors in this. So just take that for what it is. As a result, I would rather stay out of Carmax, even though I may live to regret it. I will just high five everybody that crushes it if I end up being wrong after today and it floats up. I'm a little bit too afraid to short it because if banking season ends up okay, it could be okay. So that's kind of it for me specifically on Carmax. What does that imply for a couple of things? Well, let's talk about the banking sector. And tomorrow we have a data point coming out, CPI. And I just want to one other thing. Let's go back, and this chart is why I'm worried about Carmax. Okay. Yeah, Juicy got you crazy. I agree. It could be a short, it could be a long. My challenge is that if we come out of this, then we have really low domestic auto inventories, guys. Like, as much as there's no supply of housing, there's really limited supply in used cars right now. And then when we look at what's up as far as CPI goes, hold on, I have it here. CPI. Okay, so here's the part that makes it really difficult. Okay. Now, technically, if the used car guys don't have an issue with the banks just completely cutting off their financing, which we are definitely seeing, by the way. So no one should report revenue growth this quarter. It would be shocking if they did. But this is, again, what we're seeing on CPI. Thus far, as of February, you had a down 13% year over year number. And that is why Carmax didn't try to play like they don't have defaults or anything going on. Okay. If they tried to play that, I would have been calling bluff. Yeah. And so tomorrow we have CPI come out again. And I would be shocked if we somehow got improvement on used cars, given what happened in the month of March for the banks. I'm sure the banks were like, you know what, everybody across all lending types, chill out. Let's not do any more. Let's try to minimize increased exposure, particularly to the used car market. So that's kind of that picture that I'm looking at. As a result of that, I'm thinking that in summary, who gets impacted? Carvana. I love Carvana. In some ways, I want to see him succeed, but let's just call it what it is. I'm as likely to short it or go long any given moment. And in this one can't be good for them. Now, Carvana, because of his background, because of his dad's background, the CEO of Carvana, you guys have 1001 videos on that at this point, a little bit extreme. I have like 3. Okay. So, but he's been very, very careful to try to keep the loans off of balance sheet. Whether or not he was able to do it this quarter is going to be kind of a big question. The fact is, financing, which is what he needs for the company itself, not even the cars, has already been an issue. So he's really going to be in a rock and a hard place on this quarter for Carvana. But, he's got the right relationships to try to figure out financing. So I don't want to totally write Carvana off, but it's kind of an ugly situation. Upstart, on the other hand, I think is really going to struggle because here's the deal. Upstart is the originator of these loans. And if the banks are cutting off Carmax, they're probably cutting off Upstart as well. And you still have a burn rate if you're not doing any revenue increase. Plus, I can kind of tell already that loan loss provisions going up, we'll actually get to see if this AI model is worth anything. But it kind of looks like, from what I've seen thus far, that a lot of people are banking on the model not going like this. They're using some kind of linear approach to thinking about it. And that's just not how things work when credit starts to deteriorate or when debt dries up. So that's my biggest concerns on things. Okay, let's go ahead and go to questions. Let's see. Okay, so Juicy got you crazy. It is actually kind of cheap for Strangle. I'm gonna the tough thing is Carvana reports a little bit later than the banks on Friday. So I may wait a half a beat and just see if I can get closer so I don't have the theta decay on Strangles. I know some of you guys are still learning options, but essentially there's time value. That's what the theta decay is. So as time, you kind of have some burn on that when the volatility is high. But in fairness, Juicy got you crazy is right, because the volatility on something like Carvana can actually spike up into earnings that in a way that definitely overdoes theta. I'm not sure how to think about the theta component of it relative to the vol component of it. That's really advanced for some of y'all, don't worry, but hopefully Juicy got you crazy. You got me on that and understand it. You probably already thought about it, quite frankly, but it's just something to think about. James Harris, I know you have like deep brains for cars, so I'm going to put this up. Sales of new trucks is not doing well around here. Yeah, and dealers are struggling to sell new vehicles. Yeah, and it's kind of interesting. I wouldn't mind knowing what used trucks are doing, because honestly, the price of trucks, which are a vehicle that you can make money off of, have gotten out of control. I mean, I don't know how you ever make back the money on the car, but like, I guess some people do. But yeah, it'll be interesting to see. And we probably should discuss that briefly. Just a reminder on new car sales. You've got GM, Ford, and Tesla here in the United States. I do not cover the international car companies. Even though they are quite large. I watched them out of the corner of my eye, side-eyed them. But GM and Ford, the financing business is a huge component of how they make their money. Tesla does not do that business at this time yet. Would they potentially do it in this quarter? I think we'll be watching for that, particularly since Bank of America is probably trying to figure out where they want to position. So this quarter for Tesla, I'll be looking for Bank of America to say something when they report. It's either Friday or Monday, because they come out pretty quickly here. And so we'll be watching that. But again, the thing with Tesla that people don't give credit to is the fact that they have a ton of cash. They have almost no debt. So Tesla can come out of this like a champ. I don't know what you mean by this, Israel. Let me read this. Do I think the CBDC is going to limit electric vehicle travel based on the credit rating like China limits? I don't know what you mean by that. Is there possibly a typo on that? I don't know. I don't know what you mean by that. That might be something new that I haven't considered, Israel. Sometimes I know you're focused on different things. And so let me get a little bit smarter on what it is you mean by that. Credit rating. I don't know that China limits people based off their credit rating. I've actually never heard that one before. I will say this. I've never heard that one. That's new, Israel. I'm not sure. I'm not sure where that's coming from. People can't travel out of the country easily, mostly because a lot of countries don't give Chinese people a visa, and then money is what kind of stops people from traveling. In China, I don't think credit rating so much is. I would say this actually, China subsidizes a lot of travel, particularly among senior citizens, as does Singapore for that matter. It's really interesting whenever they want to stimulate various areas of the economy, they will actually subsidize and give old people a stipend. Or what they'll do is they'll magically appear a bunch of senior discounts on all the Chinese airlines. So I'm not sure what that's all about. Okay, I don't know about social credit score. It's an interesting one. Let me think about it. Let me think about it. I don't. I think that might be presented in a way that's imprecise in the US. Because remember, they also have I think this is presented in a way that's imprecise. Let me noodle on this, but it's weird because sometimes what people do is they'll take something. You remember, China's financial system is so incredibly different from the US. Like their banking system is completely digital at this point, so it's not quite. I think what people let me come back to you on that. Let me think through where there's a couple of different nuances there that I'm a little concerned with in the way that it might be presented. Um, Repos are starting to climb. Yeah. This actually is what I'm thinking is part of the issue. And just this is a really great comment because as a reminder, a lot of times I'll say this and people won't really appreciate what I mean by it. I get it. I say things that are a little different from other kids out there, but this 13.6% decline in used car and truck prices, that directly speaks to the repo stuff. Okay. Because when you repossess a car, you then try to resell it to recapture the whatever it was, that guy didn't pay. And if used car prices are declining, it implies that the loans themselves were written at the wrong rate. It's not fair to say that. Okay, I'm saying it that way, but what it means is your default rate, the risk that you're taking for that loan is actually higher. And what that ends up being, and why all of the big banks are not doing auto lending right now, is because if there's a 13% decline in the used car price and also in correlation or at the same time you've got an increase in repo rates, then the hazard rate, which was actually used to calculate what interest rate is appropriate, is wrong. There's no other way to say it. It's not wrong so much as it's a little bit, but it's wrong. Let me just tell you what it is. Okay. So that means that, when people are talking about held to maturity and the principal component of the bond, that with respect to any asset backed security, of which auto loans are asset backed securities, that is actually exactly where you have, you start to see fractures in the market. Let's call it like that. And if you just have this like baby minimum of loss rates, like for example, Carmax is only reserving about 3%, then you're cool. But if that 3% goes to 5%, 8%, 10%, then it's not cool at that point. It's not cool because probably even if it has to do, one day I'll do like structured products tutorial so you can see what the waterfalls look like and who gets clobbered by which type of loss. But just take my word for it for right now. I know that's awful. Take my word for it right now, knowing that one day I will do a structured products tutorial so that you guys can visually see it. It sounds like a fancy word, structured products, but once you see what it is, you're just like, that's what that is? Why? There's a lot of fuss. So I promise you it will be okay. Yeah. Where you could really go wrong is when that hazard rate is miscalculated. Okay, I know. Did you see the Canada? Okay, so last couple of things. That's so funny. Yeah, you guys get your taxes in. I actually have to send my check out because I'm having problems with the e-filing for whatever reason. But get your taxes in. Every government needs your dollars right now. So help your government out by getting your taxes in on time if you owe. If you don't owe, then take your sweet little time because then they can keep the refund from you for a period of time. So if you don't owe the government money, take your sweet time in getting your refund. So yeah, Israel, you're funny on fire. Why are AMC people paying 830% of borrowing fees? Do they think they will ever cover? Okay, that I think I had Tony reach out to me, so I may do something collaboratively with Tony, but I'm not sure if he still wants to do that or if he got he had some new ideas. I think Tony Dinar is great, so it'd be cool if we end up collabing. If not, I will do another video on it. But the borrow rate it has to do with annual fee versus daily fee, and I saw this Twitter post where some broker dealer is posting a calculation for daily, annualized to daily, where clearly indicates that person does not know how to properly annualize and turn an annualized rate into a daily rate. So that's not how it's calculated. But essentially, you have to turn an annualized rate into a daily rate, and because essentially this actually has to do with the fact that just like us, the banks have to like mark any kind of derivatives book daily. That's what that's all about. So I will go through that. That's a great idea for a future show. If I don't end up going through it with Tony, is there a huge spike in the selling of MBS, like a fire sale, a margin call? I don't Johnny Bravo. I don't follow Johnny Bravo, so I have to see. Is it a fire sale on MBS? First of all, the MBS market so far is more or less okay. Let me just share that with you. And housing prices have not declined. Okay. So housing prices in commercial real estate, maybe specifically in commercial real estate office. But right now you have such a severe shortage in apartment supply, in multifamily supply, that my suspicion is that's still clearing, because basically you've got rental rates going up like this. You've got most of the REITs that are not in office. So, if you're a medical REIT, if you're a residential REIT, most of those guys have great balance sheets right now and are just waiting for distressed buyers to like give them the properties on the cheap. But rental rates have been going up like this. I'm seeing like 4% increases in rental rates on 1 year. Just by people vacating. I'm seeing 90+% occupancy rates. I'll tag the video in my notes, but residential is not experiencing any kind of distress whatsoever because they can, for lack of a better way to describe it. So I don't know. That's amazing. Thank you for letting me know that. And you guys know that I have a couple of videos out on Blackstone, ticker BX. I am watching that a little bit because with the 20% that they held in cash at the end of the quarter, I actually think they may be the one, like they really can cherry pick what they want to buy. And I think they can buy it on the cheap. And also along those lines, the only thing I might say is that, and this is absolutely what I'm looking for on the quarter with respect to the banks, I want to see who has. So I'm going to do a video on this. Maybe I'll just do a whole series of videos this week to make up for all the time I took to do my taxes this year. But essentially, I am looking to see if the CET buffers for banks increase dramatically. Meaning Silicon Valley Bank had about a 15% CET buffer, meaning that they had a ton of cash and yet they burned through it because 30% of assets came out in a single day. SoFi, which I recently did, has a 20% cash cushion, more or less, in case somebody tries to attack that bank. And so most banks, though, when they reported the fourth quarter, only had about a 10% cushion, which for them, by the way, is actually on the higher side. Their reserve requirement's 8%. So, given that you could have a 15% cushion and still wake up the next morning and close your doors as a bank, I want to see if these banks actually decide to do fire sales of stuff, in which case, like I said in my video the other day on private equity, that is one of the few places where you can ask for money. Okay. Private equity is like the daddy of of the financial sector. The only bigger daddy than private equity is your pension funds, but pension funds usually allocate to private equity for the purpose of having them on behalf of them go and find assets, negotiate those assets, and get a certain type of return. But the daddies of the business really absolutely are your private equity funds proper, your old school ones. Hopefully you guys don't make fun of me for using that language, but you know what I mean. All right, guys, that's all I've got for today. Hopefully that was helpful. I'll keep it kind of short. Let me know in the comments if you have any questions or if anything didn't make sense. Love that you guys keep me up on the things that you're seeing, and take care. Get